Welcome back, everyone. My name is Adam Rusman.
Hello.
Victor.
Hi everyone.
Thanks for joining us. Today we're going to talk about a new Singapore index coming to Singapore. It's called the iEdge Singapore Next 50 Index. Quite a cool name. Like, sounds like the next big thing.
Yeah.
But it actually means the next 50 stocks in the Singapore market after the STI.
Yeah.
So I think, in general, I think this is a good move. I think a lot of times when we look at the Singapore market, a lot of the focus is on the top 30 companies in the STI. And many investors may not actually look beyond that. Yeah. So I think this will try to change it, and we're going to talk a bit about this, what its methodology is, how do you go with how did they choose the next 50, and the components and the sector within this index. And then if an ETF comes up eventually, maybe, whether we would invest in something like that. All right, so why don't we jump into how this next 50 index is comprised?
Yeah, so it's going to comprise of 50 companies that are the top 80, but you exclude the top 30 because 30 is already captured under STI, right? So you focus on the next 50, right? So these are the companies like your Yang Tze Chiang Financial. It's actually weighted by market cap, right? And there are actually two versions. One is by liquidity weighted, right? Based on their 6-month trading daily trading value, right? And the other index is actually, which is more like an industry standard, like market cap, float adjusted kind of weightage, right? So if you look at the top 10, okay, Yang Tze Chiang, CapitaLand, Escort, right, Yang Tze Chiang Financial, right, and then your Comfort Dagro, NetLink, Keppel REITs, Suntec REITs, Keppel Infrastructure, Parkway Life REITs, ESR REITs. Okay, so these are not your companies that you won't see them in the top 30, right? And yeah, in the recent revision, right? So many others companies, right? So basically the next 50 companies after STI ETF. So they do have the reserve list like your QNM, your LHN.
So these are on the bench.
Yeah, on the bench. So in the event when any one of the companies in the top 50, the 50 companies in the constituents fail, all right, the reserve list will actually replace them. Okay. Right. So how this index is actually being structured is that there is a 5% cap per stock in this next 50. Right, and then the companies need to have a minimum free float of at least 15%. Okay, which means that they have to take out those shareholder, like insider ownership, right? And then strategic investors. Make sure that this free float is actually owned by the public. Okay, public so they must have the float must be owned by public. So must have at least 15%, and the company must have minimum market cap of 100 million in order to be inside this list. Okay, so I think the free float market cap adjusted should be the industry standard, usually. So that's how most indices are being constructed. Okay, so if you look at
actually, I want to point out something. You mentioned quite a few household names there, like Comfort Dagro, SBS Transit, NetLink, StarHub, and a lot of sometimes people who don't they know these companies. They're big companies in Singapore, and they have a international presence as well. Some of them, and actually they're not in the STI. Yeah. So sometimes you actually say, I just want to invest in Singapore. I don't want to stock pick. I just want an ETF. I'm going to go to the STI, but actually you're missing all these companies as well.
Yes.
And these are actually, like I said, household names. Parkway Life REIT, for example, is not in the STI. Yeah. So this new next 50 index will capture all of that. Yeah.
Okay, so if you look at the industry diversification for within this index itself, I think REITs accounts about 44%. There are 16 of them, and then finance company, excluding your banks, right? So your banks are already like the top STIs companies, right? And it will account about 13%. Industrial is about 13%, and then non-energy is about 9%. Telecommunication is about 7%. Actually made out of two companies. Then we all know who are there: the NetLink and also the StarHub. It's because Singtel is part of the STI top 30, right? And then you have like consumer, non-cyclical, technology, energy, healthcare, right? So essentially, if you look at this next 50, the value proposition is different as compared to your STI, where it is more like financial focus. The REITs component in the STI is actually relatively small. Okay, but this one on the other hand, it looks like the REITs concentration is actually a lot bigger, and then finance is a lot less, and then at the same time you have other sectors, right, that you can actually have exposure. Okay, so I think the value proposition for this next 50 is going to target very different crowds, right, of investors who want to have this kind of exposure besides the big banks in Singapore. So so if you look at the top 10 constituents for this SG Next 50, I think the top 10 will account about 46.6% versus STI right now, which made up of 30 companies. Their top 10 is about 77.5%. So it's a lot more diversified, all right? And then you focus on, I think largely like what Victor mentioned, mostly like cap kind of companies. Right, those companies that have market cap of between 1 billion to 2 billion to 3 billion, or sometimes it could be like 500 million type of companies. Right, they are not as big as compared to your top 30s.
But they have a minimum market cap of 100 million for this index.
To be qualified into this constituents. Right, so this is a interesting index. Right, and of course with any index you can't invest in them. Right, you need an ETF provider launch this particular product that mimic this particular index. And then the investor who wants to like have exposure in this basket of stock, like the next 50 stocks, and then of course they will have to put the money with the ETF providers, right? So right now, of course, at the time of this recording, I think there's no ETF product that you can actually invest because just launched, right? So all the ETF providers have to go and ask for more information and then see whether there will be any demand for this particular product.
What do you think? Do you think there's going to be demand for the next 50 Singapore stocks? Because I think in general, I think this is a good move by the SGX. So I think this index is basically by iEdge, which is by SGX. Right? And I think it gives more exposure to, like I said, the next 50 companies, which are also household names that are not captured by the STI. I think it's a good move in general. What do you guys think? Like the demand is there?
I think for investors who want to have ETF and then have exposure outside of the 30 companies, this is to be a good product, right? Fit, right? But generally for us, I think we have been investing in the market and then we actually do handpick a lot of companies that are outside the top 30, right? So look at some of the next 50 companies. A lot of our companies that we pick is actually inside here that are beyond the top 30 and they give very stable dividends, right? So for me personally, I think I may not need this, right? In fact, for this product, I would personally think that it could have been better if, let's say, STI were to expand the 30 holdings instead of 30, slowly increase it to 40, 50, 60, 70, ultimately maybe 80. Because right now, if you look at the top 10 constituents among STI, like I said, it's about 77.5%, which is heavily concentrated, right? And if you look at the top 3 alone, there are your banks like your DBS, OCBC, UOB, and 3 of them combine about 50%.
Yeah, that's one of the criticisms about the STI. That's very top heavy and very financial focused. This one seems to be more REIT focused, like you said.
REIT focused,
and it's more diversified, 50 companies. So that's one of the criticisms of the STI. So what you're saying now is that you would have preferred that
STI
expanded rather than have a next 50 index?
Yeah, because you might end up with creating an index that nobody wants or no ETF provider will go and create this particular ETF product because it's neither here or there.
Okay.
Right? So instead of like creating a new one, I thought that STI should leverage on its branding because everyone who want to measure the performance of Singapore market, they look at STI. This is like the gold standard for Singapore.
Okay.
I think that's what exactly the Hong Kong market did, right?
Yeah. So if you look at Hong Kong or Hang Seng, right, when they first started, they were, I think, at the launch about 33 constituents, right, and then I think they slowly increased it to 38 in 2007. After they started to include some of the head share, some of the Chinese company that are listed in Hong Kong, right, and then they slowly increased it to 50, and that is I think by 2012. And then they actually slowly increased to 52 by 2020, and then 2022 they actually have came out with another announcement that they want to push up to 80. Which by now, if you look at the HSI, their constituents at the time of this recording is about 85 companies in that, right? And if you look at the top 10, by weight is about 54%. Okay. Versus STI, which is 77.5%. Right, and if you look at top 3, Hang Seng Index only is about 24.6% versus STI at 50.7%. So it's very concentrated for STI. Right? And anyone who invests in ETF, usually they are looking for a diversified portfolio, and each stock should be like less than 10%. All right. That kind of for ETF investor, usually they are looking for a diversified exposure, lower risk. They don't want to have any concentration. So that STI should be improved.
Okay.
In that sense, right? Because it's too concentrated, and then every time when I look at STI, it's like, oh my god, it's like investing in banks. Half of it is actually bad, right? So HSI I think is a good role model the way I see it, because surely over time their top 10 by weightage continue to drop. Same thing with the top 3, and they do have a cap, right? So like Tracker Fund, I think they capped it at like 8%. Versus STI, if you look at the DBS, I think the constituents for DBS alone in the weightage is 25.8%. Right, so it's crazy. It's extremely high for DBS. So if you look at like HSI, they have 8% cap, which is perfect for ETF investor, right? And S&P 500, they don't have the cap, right? It's also industry standard. I think this is the world standard, right? S&P 500. They don't have weightage cap, but the number of holdings that they have is 500. That's why naturally when you have a top 500 companies, your weightage for each company will reduce, right? Versus STI, which only have 30. Of course, you only have to distribute within 30 companies. Now you have 500 companies. When you distribute out, your top 10 actually only account about 36.5%.
Yep. Yeah, but I think in terms of this new index, if it ever become if it has ever be a ETF, I mean, you can see from another perspective of like you are more interested in Singapore banks, or are you more interested in Singapore REITs?
Yeah.
Right. But we also must know that the big REITs are in the STI index.
Yeah.
The smaller REITs are in the thing. So even though there's REITs concentration here, you're buying more into the smaller REITs.
Okay.
Right. It's sort of like a REITs ETF, so you can see from another perspective, because the concentration is about 44% with diversity.
For people who want REITs ETF, they are pure play REITs ETF in Singapore. Right. So then in the way that this is, again, it's neither here and there. Right. So I think I will rather suggest SGX to consider expanding the STI. Right. Slowly increase it to 40 slowly, so that ETF provider can slowly
which is what the Hang Seng Index did over the many years.
Yes.
I actually think to give a counterpoint, I think the SGX actually thought of that. I don't know. I'm not in their meetings. Okay, just to clarify.
They should invite you.
I'm not there. No, they should invite you, because you were saying that they should have done it like the Hang Seng Index and slowly expanded the number of constituents in the main index, so that index grows because all the capital is there and you can grow it steadily over time. I think the drawback of that is that it takes time.
Yes.
Yeah, you can't just jump from like 30 to 50 or 80. It grew organically over time. And I actually think the SGX actually thought of that. That maybe instead of doing it organically over time, we just do a Next 50. And if anyone actually wanted to invest in Singapore as a whole, they can just do STI plus the Next 50, and that gives you your overall index as a whole, rather than they try to slowly grow this one. So I actually think they might have thought about that, and they decided to go with this and then create a Next 50. And if you still wanted to, you can just buy both, and which gives you captures the top 80 companies in Singapore. In a sense.
Well, that is a good idea if we are in the US, where you have all kind of like version S&P 500 equal weight, then there is still demand. Is a huge market. Global investors look at it, but Singapore is still small. Although now, of course, MAS is trying to support the equity market, which is a good timing to launch it, and then you test whether the market will want this particular product. But I think it will be a lot better to just expand the STI to slowly.
Okay.
That's my take.
If you remember when in the US markets a long time ago, not too long, because I'm not that old, but it used to be the Dow, right? Everything was the Dow 30. Now is S&P 500 all the way, so that index became the number one index in the US market. So I think the SGX could have done something like that. They could have kept with like the STI 30, and they could have done an STI 2 with 80 companies, like the 30 plus the 50. And this is a new index. But then instead of like creating one big one, they decided to split it into two. Keep your original STI plus the Next 50, and then you have the flexibility of just keep having this one or both together. I mean, I'm sure there's an ETF product that's going to come up eventually to cover the Next 50 index. I would think so. All right, and then you have a choice as an investor to go with like this a 30, just a 50, or both as an 80, and that captures the Singapore market. I don't think we can't have an S&P 500 in Singapore because we don't have 500 companies.
No, we don't.
So we have to do 50, like 30 and 50 with 80 is just nice for us. So I think they might have thought about doing the Hang Seng route, but that would have taken time, and they may have just decided to do with this hybrid approach, which gives you like the flexibility of both.
Because with the Hang Seng Index, the expansion also, they do the market consultation first.
Okay.
Right, and that was in 2020. A year later, then they came out with the final revision, which is they say they're going to increase to 80, right, and then ultimately will reach 100, right, which is a good move, because Hang Seng ultimately, of course, is a big market, and then you have China, a lot of Chinese companies that are listed over there. So I think let's just bring it back for people watching this who are investors. So let's assume that one day there's going to be an ETF that will track the Next 50. We already have ETFs that track the STI. You mentioned that you wouldn't invest in this because you kind of like handpick. You do stock picking. You and Victor do stock picking. But for someone who doesn't want to do stock picking, they're interested in the Singapore market because there's local currency, the yields here are stable, etc.
Would someone like that should they stick to the STI, or should they go with the next 50, or do both? What do you think?
I think they should just consider Singapore, but also consider global market as well.
Okay.
But for someone who really don't want to go global, then of course this is actually a good introduction, right, for people to have like more exposure into the next 50 largest company besides the STI.
Yeah, because like I said, the STI is very top heavy. And some people don't like that. They want more exposure to other areas of the Singapore economy, which the STI doesn't capture enough of. And then the next 50 actually solves that problem and say, hey, these are the next 50 companies that captures other parts of the economy, which are actually in their own right pretty good companies like ComfortDelGro and Parkway Life REIT, etc. and all that stuff. These are names that we actually invest in ourselves. Some of them, not all of them. What do you, Victor? What do you think about that? Should investors have a look at just the STI or both, or just the next 50?
I think if you really want to capture the whole Singapore market, then you should do the both.
Okay.
Right. I mean, but if you are very comfortable with the banks, and yet, because some people I know they tend to just buy the banks.
Just the 3 banks, that's it.
Yeah, but there's no diversification.
Yep.
Right?
Yeah.
So if you just want the banks with diversification, I think STI will do the job.
Is that enough with diversification? Because the STI is really like half of it. Yeah,
but
there
there's at least some diversification.
Okay.
Right? But if you don't want really a lot of diversification, then you should consider the both. But provided there must be a ETF. If they launch this index but there's no ETF, then there's not a
that's true.
Point already, right?
So it's early days because this index is very new. The next 50, but I do expect an ETF or 1 or 2 to come along eventually. I think. I don't know.
I think this iEdge is under SGX. Launch it, right?
Yeah.
Because I think we have a FTSE mid cap
and small cap,
a small cap index, but I don't think there's an ETF for that.
Okay.
And then of course iEdge has their S-REITs indices, right? So there's the pure S-REITs ETF, right? So this is the one that
And there are ETFs that track this index.
It's also by iEdge.
By
which is SGX, right?
Yeah. So I do expect actually a next 50 ETF to come up eventually. It kind of makes sense to do that. But again, we're not recommending anything, and we're not being paid by SGX to do this. We just wanted to cover the next 50 index because I think it's a step in the right direction. All the time, whenever we talk about the Singapore market, it's always the top 30 companies, which is a little bit top heavy, not so diversified enough. And I think the next 50 actually solves this problem straight away. If you went with the Hang Seng route, it would take a number of years to get to that level of diversification.
But I think STI is a good brand, so you should improve it. And put a cap on the top, each stock's contribution, right? Rather than having one single stock contributing 25%. To me, as an ETF investor, I would not consider. All right. But again, there isn't a lot of product, right? STI ETF is probably the only one that you can consider in Singapore, right? So this will be again is a good exposure, a good alternative for someone who want to consider the next 50.
Okay. So you just want to cover it. Anything you want to share? That's about it. All right. So I just want to cover the next 50, this new index in Singapore, and what we think about it. So when the ETF comes up, you can actually consider whether you want exposure to the next 50 companies in Singapore. All right. So with that, my name's Adam. Rusman, Victor, thanks for joining us. Any questions about this, we're happy to answer them. If you like this roundtable, please hit the like button, and of course subscribe to our channel when more roundtables coming up, and we'll see you again.